Hey guys, Money with Yumi here, where I talk about anything and everything related to money and how to grow your wealth. And today, I want to show you why investing in real estate in Singapore, specifically condominiums, is probably one of the worst investment decisions that you can make. And this is one of the main reasons why I'm no longer interested in investing in real estate in Singapore, unless maybe it's like a 4 or 5 room HDB BTO. You've probably heard a lot of property agents say, this is the time to buy now. Invest in a condo. Interest rates are low. Yeah, I'm calling for any property agents in Singapore to bring me some solid numbers for any condo in Singapore right now that gives a positive cash flow with only a 25% down payment. And then we'll talk. Because my caveat, something that really pisses me off is that a lot of these agents do not know how to calculate profitability and oftentimes sell the idea of possible capital appreciation and then provide false hopes to their clients. Even though I'm based in the US, I'm still keeping myself updated with the real estate market in Singapore. While property prices have gone up this year, rent prices have not been great for landlords. Because of the Coconut pandemic, not many foreigners are going to Singapore to work, so rent prices actually dropped last year due to the lack of demand. So yeah, while prices are increasing this year, it is still not higher than pre-pandemic levels. There are a lot of rentals in Singapore that is still vacant and it's just sitting there with no tenants. So what affects property value in Singapore? There are 4 main factors. The first, is it a public property or a private property like an HDB, executive condominium, or a landed house? The second is location. Is it located within the central core region or outside the central core region? And obviously properties within the central core region is going to be more expensive than outside the central core region. The third would be tenure. Is it freehold, 999-year lease, or 99-year lease? And freehold is definitely more desirable. The fourth is age. Let's say you bought an HDB with a 99-year lease, because most HDBs are 99-year lease, and there's only 20 years left, then that's going to be cheaper than if you bought an HDB with 70 years left. And if it's a new development, it's going to be a lot more expensive than other similar properties that are around that area that are older. All right, whenever I'm running analysis for properties, right, I don't go based on potential numbers, I go based on actual numbers. And seeing is believing, so let me show you. Let me grab my laptop and then I'm going to Google top condos in Singapore. We have Hilltops luxury apartments, the luxury, and Draycott 8. I'm just going to use Hilltops because it's the first one on the list, and then I'm going to go on propertyguru.com.sg. And the cheapest listing for Hilltops is this one. It's selling for $2,488,888 for a 2-bed, 1-bath, 807 square foot. And it's on a low floor. And then let's look at past transacted prices. We'll go to URA's website, and then we're gonna search Hilltops. Over here, it's the same square footage. It was sold for $2,550,000, but it's on the 6th to 10th floor, so it can be considered middle to high floors since Hilltops has only 19 floors. If I remember correctly. And then let's jump into URA's rental data. And we'll check how much Hilltops has been renting for. Rental contracts of private residential properties. We're going to enter Hilltops. Okay, look at this. These are all actual numbers, right? And all right, there you go. Bingo. This one is a similar square footage and it's being rented for $6,400. It looks like you're balling it, right? Making $6,400 a month in passive income. Don't be fooled by this. This is an illusion. Let me explain why. When you buy a condo in Singapore, it comes with a hefty price tag, also known as the condo maintenance fee. This is a fee that you have to pay monthly to your condo's property management company in order to cover the cost of upkeeping the building, the common areas, and security. And for Hilltops, the maintenance fee is $925 a month. It's very high for a new development, but usually Central Core Region properties would have a higher maintenance fee than if the property is located outside Central Core Region. So I'm going to give you 2 scenarios. So scenario 1, let's say you paid it in full And let's round it up to $2.5 million so it's easier to calculate. So that is $2.5 million in cash plus $84,600 in stamp duty, which, by the way, is non-refundable. And this amount is only if you're a Singaporean buying your first property. If this is your second property as a Singaporean, then you're looking at $384,600 in stamp duties. It's a huge difference. That comes up to a total of $2,584,660, and if you're renting out your condo for $6,400 minus the condo's maintenance fee of $925, you'll get $5,475 a month before property taxes, insurance, and income taxes. That's only a 2.55% return on your money. The CPF-SA is 4%. If your investment is lower than the CPF-SA, it's a terrible investment. Right? Put it into an S&P 500 index fund and you'll get about 7 to 9% returns a year on average after accounting for inflation. And for scenario 2, if you're like most people and you have to finance this condo and take a loan of a maximum of 75% of the home value, that means that you have to put a minimum of 25% down payment. That would be $625,000 in down payment and $84,600 in stamp duties. So you add that up together, that would be equals to $709,600. This is the total amount needed to buy this condo with a loan, and 75% of the purchase price means you will have a mortgage of about $1,875,000 with interest rates hovering at about 1.35, 1.4%. You're looking at a monthly payment of $6,337. So if your rent is $6,400 and you have to pay the condo maintenance fee of $925 and then pay the bank for your mortgage of $6,337, then you're technically losing money on your money. At least $862 a month, or a negative return of 1.45% a year. Remember, I have not factored in taxes, insurance, vacancies, repairs, all that kind of stuff. So why would I invest in something that's gonna give me a negative cash flow and I have to pay extra out of my pocket each month? And don't even get me started with the folks that buy and own more than 2 properties in Singapore and paying 12 to 20% ABSD. That doesn't make sense to me. Like, I don't get it. Why? Why? Am I stupid that I don't understand why? And if you're going to mention capital appreciation, then you're just speculating. A lot of people who buy new developments, new condos, they hope that the price is going to go up slightly before or after TOP, which is the condo's completion date. Sometimes they get lucky and sometimes they don't. Let's say you bought a 2-bed, 1-bath condo at Canning Hills Piers, which sold like hotcakes recently for $2.2 million. You have to pay $73,000 in stamp duty. And if you're paying your agent a 2% commission for selling the property for you, you need to sell the property for at least $2,318,868 to break even, and this number hasn't factored in other costs like interest paid to the bank. And even if you manage to sell the condo for say $2.4 million in 2025, when it's completed, that's only a profit of $80,000. But if you put that 25% down payment plus stamp duty to an S&P 500 index fund with an average rate of return of 7%, in 2025, after 3 years, you will have a profit of $140,000. Now, for this condo to beat the market and get an annual rate of return of 7%, you should be only paying $1.01 million for this property with rentals of $6,400 a month, and with a purchase price of $2.2 million, you should be renting it out for $14,500 a month, and both scenarios are highly unlikely. And if you know anyone that bought new developments in the past 3 to 5 years hoping to make a profit slightly before or after TOP, there is a high probability that they did not make any money and ended up losing money if you factor in all the costs. Especially when there's a premium pricing to new developments, it's hard to flip and make a profit. More often than not, I see these new developments 3 to 5 years after completion still hovering at the prices they were bought at. So in my personal opinion, capital appreciation should not be used as a strategy when you're buying properties as an investment, but it should be looked at as a bonus when you're projecting your future profits. If it appreciates, that's great because it adds on to your ROI, but if not, cash flow is key to real estate investing and building wealth. Or at the very least, you break even after all costs are factored, so that way your tenant's paying your loan for you and you're gaining equity that way. So should you still buy real estate as an investment in Singapore? Yeah, absolutely, when the numbers make sense. For example, having insider information about possible en blocs, buying them low and selling them high when the developer bids for the entire development. But what's the possibility of that happening though? And it still kind of feels like gambling, doesn't it? HDB BTOs are still the best investment for real estate in Singapore. You buy it at a discounted price because of government subsidies, and then you can either rent it or sell it after 5 years. Two things though, you need to be married as two Singaporeans or a Singaporean who is single at 35 years old. Alternatively, you can buy a distressed private property like a condo or a landed house that is below market value. Maybe a foreclosure or an auction, but those tend to sell at market value. It took me a year for me to find mine, and I have to say I got lucky because I bought it sight unseen, below market value, with a foreign seller who's no longer in Singapore, so they were kind of like desperate to sell, a paying tenant, and the best part, it cash flows. Not a lot compared to my properties in the US, but at least it does, right? If you're considering buying a property in Singapore as an investment, please make sure you run your numbers. I can tell you right off the bat that for about maybe 99% of the condos to cash flow in Singapore, you will need to put a down payment of at least 40 to 50%. And that's going to give you a relatively low ROI, return on investment. And as you might already know, you don't actually have to own physical property to invest in real estate. If you want to diversify your investment portfolio into real estate, there are other alternatives like investing in a REIT, real estate investment trust. It'll bring higher returns than owning physical property and without the risk of being a landlord. For example, Mapletree North Asia Commercial Trust, MNACT, has a trailing 12-month yield of 5.73%, and Cromwell European REIT has a yield of 4.97%. That's all I have for today, guys. Don't forget to smash the like button, subscribe to my channel, and ring the bell icon so you get notified whenever I post a new video. And let me know in the comments down below if you would still invest in real estate in Singapore when the ROI is so low. I would love to hear your thoughts, and feel free to follow me on my Instagram if you're interested to know what I'm doing in my real estate journey. And if you like this video, I have another video for you, and that is understanding real estate in Singapore. Thank you guys so much for watching. I'll see you again next time.